Welcome to the Expansive CEO podcast. I'm your host, Hannah Chapman, founder of Expansive CEO and X Squared Wealth Planning. Buckle in as we explore how to create true prosperity and build a business and a life that expands beyond yourself and makes a dent in the universe. Welcome, everyone, to this episode of Investment Friday with Brad Haines, the Chief Investment Officer of Juncture Wealth Strategies. It is Thursday, November 16th, when we're recording. It's a little earlier in the day, 1:52. So just to put a timestamp on that, and it'll be released on Friday, November 17th. And we've got all kinds of stuff. We've got two awesome questions from our favorite listener, Bob from Huntsville. So we'll go over those and market update. And then also we've got a holiday week coming up. So there's a few things that we're talking about. How are you doing, Brad? Are you ready for Thanksgiving?
I'm doing great. And yes, I am. You know, holiday shortened weeks are always fun to spend time with family and be grateful for everything we have. We talk a lot about investments, and sometimes we can get clouded in what I'm not getting, what kind of return I'm not getting this year, particularly if you didn't own the Magnificent Eight. But I think we need to step back, and Thanksgiving, it gives us a time to be grateful for all the blessings that we have, both in family and jobs and all those. So yeah, I'm ready. I'm excited for it, actually.
Awesome. Yeah, so Thanksgiving is actually my favorite holiday. It's my very favorite holiday of the whole year. And partially, so my family, I think they would all say their favorite is Christmas. Partially because of the presents, but also they love the decorations and all of that, putting up the tree. I enjoy that too. But for me, Thanksgiving has always had such a special place in my heart, in that, like, it's not about the gifts. There are no gifts, right? It's about food. I love throwing a good dinner party, so that's part of it too. But just, having the foods around you that are so comforting, and being with family and spending time together, right? The meal is part of it, but then it's just like the sitting around the table and just getting to connect with people. That has always been my favorite. And every year we go around and say what we're thankful for. Like, what are you thankful for this year? So let's do that, because we're not recording next week. So I'll say that we're not recording on Thanksgiving Day. We're not going to do it. So there will be no episode next Friday. So Brad, what are you thankful for this year?
Honestly, I'm thankful for the freedoms we enjoy. I'm really thankful for the freedoms we enjoy, and for having the ability to be in a country where I can own a business, I can create my own path, I can help my family get to the goals that they want to accomplish. This last weekend, my oldest son got married, and so I'm very grateful for that, for his new bride, and for family. I'm just really grateful for, again, the freedoms we enjoy, and so that's kind of hit me over the past couple of months. Well, really the last couple of years, but particularly with all the conflict going on in the world, the United States is in a very blessed position geographically. We're pretty safe. We've been blessed with economic growth and productivity and innovation and entrepreneurial activity and all of those different things that make up, who we are as a country. And that is what I'm particularly grateful for right now.
Oh, that's beautiful. I love that. I love that. And for me, this year, I'm really thankful for the way that a lot of my relationships have really deepened. And that's kind of across the board. I was able to go on a retreat, and a couples retreat with my husband last week, 2 weekends ago now. And it was so wonderful. It was such a wonderful time connecting with him. And That'll be one of the things that I'm just super grateful for a long time, I think. And deepening relationships with my children, um, just with the rest of my family, with clients, with people who I'm partnered with in business. Just really, I feel like I really expanded in relationship building, even though that was a thing that I was like focused on anyway. I've always been a relationship builder. And this year, 2023 in particular, really feels like things went deeper. And I am so, so grateful for that opportunity. Um, and similar to you, that the ability that we have, right? This podcast is called the Expansive CEO Podcast. And, I have two LLCs and am creating, and that co-founding another one with a partner. And it's just like, we wouldn't get to do that everywhere. And I wouldn't, in any other time in history, right? For me as a woman, I wouldn't necessarily have been able to do all of this either as easily and as readily as I've been able to, figure it out and launch things and have support and build successfully. And so, yeah, it feels like there's a lot to be grateful for.
Yeah. Even as you mentioned that, this is a prime time in history as you as a woman. I mean, you're a mother and you have kids that you're helping raise, and you're able to do that from your home
Mm-hmm.
and still pursue your career and raise a wonderful family. So it's pretty, we get a lot of down news, negative news, things to worry about, things to stress about, and yet really we're living in one of the best times in the world ever, in the history of the world. you
Yeah.
know
Yeah.
I don't have to worry about being thrown into slavery somewhere or thrown to the lion's den to fight in the Coliseum. And so I'm pretty happy about that, because
Right.
I would be just a nugget
Just be some
of
lion meat.
of meat for a lion. So I don't know how I do against a male lion, but probably not very well. Now this couples retreat, let's go back to that. Was that in a Caribbean island?
No, it was in the like countryside in Nashville,
Oh,
out in the country, and it was so beautiful. It was so much fun. Um, yeah, and yeah, there was creeks around us, heard coyotes at night, like all the whole
oh,
thing.
that's
Like
awesome.
it was so fun. So yeah, it was just a really good time of connecting. My mom flew out. My mom is out in Arizona. She flew out and watched the kids, and so they had a fun time. And yeah, it was it was different from what we've done before, right? We're
Oh, hey,
shaking it
good
up
for
this
you.
year,
Good for you. That's
right?
awesome.
Yeah, yeah. So maybe next time. Well, probably not a Caribbean island. That's not really our thing. It would be more like, let's go to the mountains. Let's go to
Yeah.
the let's go to the Pacific Northwest and see, uh, Olympia National Park and those kind of
Hey, you can always hike the
things.
Pacific Coast Trail.
Right, right. There's a lot. So
Yep.
next year that'll be on the docket. So
Sounds good.
let's talk about what's going on in the markets this week. What came up, and or do you want me to read the questions first and have that lead into?
Well, let me give you a little update on what's going on in the markets, because I think it's been very, very interesting. If you remember, late last week, we talked about, or late last week, the markets jumped when everybody realized that the Fed is probably not going to raise interest rates any further. And so long-term yields on US Treasuries and corporate debt came down pretty significantly, and that gave a real buoyancy to stock prices. And what's interesting to me is the things that rallied the most were the areas that had suffered the most over the past really almost 24 months. You had small cap, real estate. The areas that have just been beaten up like crazy were actually the ones that rallied the most during this past week. Um, and so that has continued until today, where we're taking a little bit of a breather as the market has been on the very short term a little overextended because we've rallied so much in the past 5 days that it's inevitably going to take a little bit of a pause, and that's what it is doing today. Nothing major, just down a little bit. But a lot of that news is all driven by the yield action and what's been going on in yields of bonds relative to stock. And that's the major news.
Yeah. So that that space of the yield. The other thing I read this past week with treasury sales not quite making what they thought they would make. Or a little bit of crunchiness there with a release
Yeah,
last week.
what they came out and said was, so that's the calendar of issuance that they released last Wednesday, which was essentially they're not going to issue as much treasury debt over the next 3 months as people had anticipated. Now, don't get me wrong, they still said they're issuing a lot of treasury debt, but it was less than people expected. And so that again gave a little bit more buoyancy in terms of, okay, bond, we don't need to have our yields this high. So all of a sudden bond prices rallied, yields came down, and then again, everything that's really related to interest rates, particularly small cap and real estate, rallied the most over the last 5 days. So it's been an interesting dynamic, but I've said for the last couple of months, everything going into the end of the year is going to be based on what long-term yields do. If long-term yields stay around 5%, equities were really going to struggle. If they rally and they come down, those yields, then equity markets are probably going to rally a little bit. And so right now it looks like they're probably going to rally towards the end of the year here.
And so going into next week again, so next week is a short week trading wise on the stock markets. What do we typically see in especially Thanksgiving week, since it's, there's so much going on, and then it jumps, pretty much right into the big holiday spend
Yes,
afterwards.
Christmas. Yeah.
Black Friday into Cyber Monday and all of that.
Exactly. So generally what happens is it's pretty volatile, but it's usually positive. Okay. On the Thanksgiving week. But for the most part, most market participants are on vacation for at least half the week, if not the whole week. And so the volume is probably generally pretty light, which makes movements in the markets a little more exaggerated. And so, yeah, it may be more volatile, but usually it's on the upside. So people usually don't mind that. It'll be interesting to see because of this week we've had. If we consolidate those gains here towards the end of this week, then probably next week is going to be pretty positive for equities, particularly if we have, lower yields, if those yields maintain where they are today.
All right. Well, at least we have that for next week. That's our projection, right?
Yes,
Potential. We'll see.
potential.
And then, like I mentioned, Black Friday, Cyber Monday, a lot of that economic data will start to formulate opinions for December and see what the holiday spend, Santa surprise, is that what we call it sometimes? So silly, but that's okay.
Well,
In
it's interesting
December.
because the Atlanta Fed's nowcast, which is again, it's not a forecast, it's what's happening today. Nowcast it's currently around 2.2%, which is much better than we were expecting. So conversely, Walmart came out today or last night and said, we're starting to see that the consumer's starting to stretch a little bit. They're starting to trade down to more inferior goods relative to normal goods, and to try to save some money. So, that it's that play between the stress on the consumer and the consumer spending versus we're doing okay. So it'll be interesting to see. Now, what's odd for people is we have bad economic data. It is now being interpreted as good for the financial markets. because a slowing economy means less inflation. Less inflation means lower interest rates, which means a better time, lower costs for companies, which means more profits, which means, hey, we can bid up these stock prices a little more. So
Hmm.
it's a weird dynamic when bad news equals good equity market returns. So it's something that confuses most people, because it's, when we see people getting laid off, we see people being constrained on their incomes. For some reason, that's good for the economy. So it's an odd thing to think about, but that is the way it's being interpreted right now.
Hmm. Interesting. Well, we'll see what that turns into for the rest of the
Definitely.
year. So let's go to these two questions that, when we talked about this before that we started recording, you said, actually, I think these are pretty related. So they kind of feed into each other. So the two different questions. One is about China. And the question is China in trouble with $11.8 billion of foreign investment leaving China last month? Their youth unemployment rate is pretty high at 34%. And what are the ramifications, if any, on the US investor? So that was one question. And then the second question was, should a savvy investor be concerned by Moody's comments, and Moody being one of the rating agencies that rates bonds, right? And so they were talking about the rating of the US government, like, right? That's what we're talking about. So if so, should we be concerned by the comments they made this week? And you'll elaborate on that. And if so, how should we adjust? If we should adjust, right? So those are the two questions. And so I'd love to hear your take on that. What are we looking
Okay.
at?
So I'm gonna talk about China, because I think it's a very interesting dynamic that is going on. Um, China has been the growth engine of the global economy for 30 to 40 years. I mean, they have really done a great job in setting up that manufacturing economy where they became the manufacturer of the world. I mean, I remember growing up, and a lot of the toys that we would play with were made in everywhere around the world. And then all of a sudden it started transitioning to made in China. Everything started to become made in China. And that is where we are currently still in that situation where a lot of us, a lot of the goods we purchase are made in China. In fact, during the pandemic, I think a lot of Americans were surprised to find out that their medications that they rely on are manufactured in China. And so people with heart medications, people with insulin, I mean, a lot of those uh, consumers started to realize, wait a minute, it's made in China. What if we can't get goods from China? You know? And so during that time, again, China shut down for a very, very long time because they implemented what they called a zero tolerance policy. And so they shut down their economy for a very, very long time. And they're still dealing with the negative impacts of that shutdown. It's why their youth unemployment very, very high. It's why their consumer spending is not doing well. It's why their property market, where they misallocated too much money towards this development area, real estate development, and now they have many large developments with no one in them.
Hmm.
No one in them. And they're very levered. So not only is it you have buildings with no one in them, you also have them being levered. So how does that correspond? How do they work out? It's not a surprise that Chairman Xi all of a sudden shows up in San Francisco at an APEC conference to meet with Western leaders.
And what's
Okay.
APEC for our audience?
Uh, it's Asia Pacific Economic Council. I believe that's the acronym. I apologize because I have not looked it up in a very long time, but I believe that's what it stands for. And it's a way for Asia Pacific, the Asia Rim, including the United States, Canada, all the way around kind of the Rim of Fire, if you will, if you remember that.
Mhm.
China, all the Southeast Asian countries to come together to work with Western or business leaders to foster economic relationships. Well, he hasn't been there in 6 years.
Hmm.
Okay. So for 6 years, he hasn't shown up. 2023, he shows up. Why? He's there because the Chinese economy is suffering. And in a communist country, you can have a lot of distress. You can do a lot of things, but you can't have low economic growth for too long because that destabilizes the social structure, the governmental structure, because any government is based on the will of the people. I mean, at the end of the day, every communist monarch, every democratic leader is based on the will of the people. Now, in some of those, in authoritarian governments, generally they revolt and have a revolution, which is terrible. But, well, terrible, it could be good. It just depends
Right.
on
It's
perspective.
it's very volatile. We can use
It's
that
very
term, I
volatile.
think,
It's
right?
painful.
Yeah.
It's painful in the short
Painful
term.
growth. Yeah.
But if all of a sudden you have 1.4 billion people decide to revolt, that's a real problem for Xi. Okay. So he is trying to foster economic relationships where over the past couple of years, the US and European business leaders have said, hey, wait a minute. We don't know if China is going to be there for us. Not only do they have the pandemic where they shut down their supply chains, right? And so getting the goods out of China was a very difficult, expensive process. So they don't know, is that supply chain going to be there in the future for us no matter what? Or are there other considerations? Maybe we should bring it to Canada, bring it to Mexico, bring it to Vietnam, bring it to other countries that are not going to have such draconian regulations and rules. But the second thing is also the US or the Chinese government has gotten very involved in business. Jack Ma, who is the chairman of Alibaba, was all over the news a lot, and in Western and in Chinese government, or in the media.
Mm-hmm.
Well, he got chastised by the Chinese government, and ever since that time has kind of dropped off the radar completely.
Mm-hmm.
And so the supposition or the problem is as a Western company, am I gonna have my employees, my business managers in my Chinese plant, are they going to have to start doing things for the Chinese government because they're being forced to? So it's all related is it safe for my intellectual property? Are they going to respect my rights? Historically, they have not. Are they going to strong arm my employees that are in China to report for the Chinese government or to do things that would be against US policy? And if I do set up a plant there, am I going to be able to get my goods in a timely manner as in a stable fashion? So those concerns have driven a lot of business away from China and into some of the other Asian tiger countries like Vietnam, Thailand, Indonesia. Those are actually benefiting significantly from offshoring to other areas from China, but also the U.S. The U.S. We're building a lot of manufacturing plants in the U.S. right now because of the Chinese policies over the past 5 to 10 years.
Yeah, the semiconductor plants come to mind, both in
Yep.
Arizona and so interesting connection for me, right? In Arizona, I've
Yep.
driven past them, where Intel is building these huge plants for
Massive.
semiconductors, absolutely massive. And then also in Columbus, Ohio.
Yep.
One of the, I think it's the biggest single business investment in Ohio's history is
Yeah.
that semiconductor plant, which is mind
Enormous.
boggling. Yeah.
Yeah. I mean, it's tens of billions of dollars of investment. Near my Arizona home, Uh, there's a couple of other ones going in the northwest of the Phoenix metro area. And that's, again, it's another $5 to $10 billion project being pumped into that economy. So it's an interesting dynamic, but China is kind of struggling. And so from an investment standpoint, it's something that I watch for. One of the things that I always have maintained is, as long as you know the rules and the rules are consistent, you can make money in an economy. Okay. It may not be as easy as other economies, but you can. Well, China, because of their disrespect for the rule of law and intellectual property, and because they have ulterior motives from time to time that may influence their policies, I have stayed away from buying in China investments, because I don't put it past them that they could nationalize the business as soon as they want. You know, I think of Tesla having one of their main plants there, and that's no surprise that after Tesla set up a plant there, all of a sudden BYD, the Chinese competitor, has really started to overtake Tesla. Okay, so interesting. One of the largest car markets in the world goes from 0 to 100 much faster than Tesla. And Tesla is kind of the innovator in that area. So, if I was Elon Musk, I would be very concerned that my intellectual property was being bled out the back door at a pretty rapid rate. That said, that's something that is high risk, high reward. At some point in time, China, if they decide to enter the market economy like they were doing a number of years ago, where they had massive growth, then I would be very interested in reestablishing some investments there. But at this point in time, I think I'm passing. I've been passing for the past 10 years. But I owned a lot prior to that time and made a lot of money on it.
And so how does that then move into the discussion about, the US debt?
Yep. So there's a reason he's in the US. Okay. So everything is relative in investments. Okay. The US got not downgraded, but negative comments. They were put on negative watch by Moody's a week or two ago. So should we be concerned? Absolutely. That's a warning sign. That's saying, hey, US, you've basically doubled over the last 10 years. You've doubled your debt. Okay. From 2016 to 2020, we added $7 trillion in public debt on the US balance sheet. Okay. That's a lot of money. And it has accelerated since that time. So it's not just the level of debt, which is it's high, but it's the growth in the debt, the growth in those deficits that we're funding with more debt. And the problem is now we have higher interest rates, right? Well, I think in the next 2 years, we have a third of all publicly traded debt, US Treasury debt, that is coming due. Well, they're coming due at very low interest rates, and they're getting rolled over at not so low interest rates. So that is going to start constraining, because you have the situation where, okay, our taxes only bring in so much money. Are we going to pay 100% of our tax collections in interest? I mean, that's a possibility. Okay. And so if you have close to, it's estimated they're going to have almost $1 trillion, not quite $1 trillion, but $1 trillion in interest alone.
Wow.
Per year. Okay. Well, so now you start to look at saying, okay, what can that do to the investment markets? Okay. Right now, the investment markets are going to say, you know what? the US's balance sheet isn't as great as we would like it to be. We would like to have the debt a little lower, but we're still one of the best. We're one of the most stable countries, economically speaking, from a rule of law. We have deep and wide liquidity in all of our financial markets. We have business friendly, for the most part, not all the time, but generally business friendly regulations and laws, that you can come in and and the U.S. consumer still spends. So, we may not be a great, may not be financially in a great spot, but generally speaking, we're better than the alternatives. So if you look at the alternatives, you can look at Europe, where you have not a very deep market for debt. You have a monetary union, but not a fiscal union. So again, you have these various. So it's like a collection of countries, not one country. So
tell me more about that monetary union, but not a fiscal union.
right. So the European Central Bank sets monetary policy for the euro area, right? Well, but they have their own tax rates. They have their own tax treaties. They have, one has higher taxes than the other. One has different types of taxes than another. So it's not one. It's not a one union. So, for example, Germany will borrow money in the public markets, right, at different rates than Italy. Okay. Well, it's not like a Euro Union. The European Union is issuing European bonds backed by all those countries. They've talked about it from time to time during crises that come about every once in a while, particularly when Greece and Spain and Italy were going through some real significant struggles. They talked about it, but they decided not to do it. So again, that monetary union, fiscal union, not a consistent rule of law across the countries or consistent laws across the countries. So it's good from a population standpoint, because it's about, if you collect all those countries' population about the same size as the US, their economies collectively very, very solid, very large. I shouldn't say solid, very large, very important to the global economy. But again, just not deep enough markets, not liquid enough, all of those things. So
not cohesive.
Not cohesive. So Europe's not a very good alternative to the United States. So you look at, okay, what are the other countries? Well, there's BRICS, Brazil, Russia, India, China, and South Africa. Okay. They're considering putting together a currency and hopefully trading in that currency across with each other. All right. Let's see. Russia and China, we're going to trust those two to pay their bills. I mean, Russia has just absolutely gotten annihilated, their economy, and they're having to spend upwards of 30% to 40% of their GDP on military goods that are getting blown up as soon as they put them in Ukraine. Mm-hmm. Russia's probably not a great place to be. Their economy has gotten annihilated. China, you have a very, very slow economy, not very open. Only certain parts of it are open. Similar with Russia, not very open. A lot of sanctions around it. Can't really do business there for the most part. Same with China. And by the way, they don't trust each other. So it's like, okay, you have all of these dynamics that probably don't make it a real alternative. Okay. So for right now, the US may be, I'm going to use an example. This is from a commercial from years ago. We may be a pig, but we're the prettiest pig in the pond. Okay.
Pig in the pen.
Yeah. Like, we've got lipstick on us. We're looking good compared to the other, pigs in the patch. So it's something where the US is the best alternative in the world. Now, does that mean that Congress can just continue to spend forever? No, no. Right now, we have fairly low tax rates, but if we continue to add debt, eventually we're going to have to increase our tax rates to pay for some of these things. And it's going to be it'll have to be a little draconian. So what happens is if you increase tax rates, you slow down economic growth. More people go out of work. Okay. But you have to pay the piper, if you will. So that's something that the US government really does have to start to rein in on. I know there's a bipartisan legislation that was just submitted by Senator Mitt Romney and Senator Joe Manchin. Romney from the Republicans, Manchin from the Democrats, and it's something that with the, I can't remember the name of it, but it has something to do with increased fiscal stability or something to that effect. And it's important to understand that we need to start having Congress manage our finances in a better manner. You can't just spend all of the time. And it's both parties. Like I said, President Trump's administration increased our debt by $7 trillion within 4 years. President Biden has added a lot to that debt balance, partially because of the pandemic-related relief, which needed to happen, but still, it happened. Generally, what happens is you need a reserve, kind of like a line of credit to the side, where you knew if you go through a pandemic, a war, if you go through something extraordinary event, you could pull off that line of credit, issue some of that debt, take in cash, and expand your fiscal policy, by deficit spending. But when you get out of those times, for example, if you go through a war and you've transitioned back to a peacetime economy, you need to pay down that line of credit a little bit to make sure you still have that cushion available. Well, the problem is we've been spending that on that cushion for a long time, and now we don't have much left. In fact, one of the main things that was troubling to the U.S. Treasury market, it's one of the reasons that we hit 5% on the U.S. Treasury note a couple months ago, was because Japan has now allowed their interest rates, to those yields on those Japanese government bonds, to start to float up. Now, why does that affect ours? Because they're at 1% versus us at 5%. It's because Japanese economy is also viewed as a very safe economy.
Mm-hmm.
Very safe. So it's one of those things, even though they have a high debt, they're all self-funded. It's all funded within Japan itself. So it's one of the things that people are like, well, is the Japanese government bond a good alternative to U.S. Treasury? I don't think it is. Okay. But for others, it may be. So you now have a competing investment to U.S. Treasuries, which means it now has to have a more competitive yield.
And not that it couldn't be in the future, right? Like I think that's kind of where that discussion is going, is if the US is downgraded, or even more talk of that, right? And then suddenly we have these other, maybe at least one other option, that could become, and is that bad? Like maybe it's good if we have two relatively stable options, right? Like it's not just the one. Like, in all honesty, that's probably better for the global economy if we have, spread out the stability a little bit. But maybe that's my optimism.
Yeah. I think
My
it's
generally
important.
optimistic view.
Yeah. I think it's important for people to realize that, first of all, the US has a lot of assets. Okay. So we have a lot of debt, but we have a lot of assets, and our economy has grown pretty significantly. So, are we in trouble? I mean, we're knocking on that door. But I think it would be able to, I think we'll be able to weather it. I think that we'll be forced to weather it. I mean, I think one of the things they should have done, the Treasury should have done, is lock in these long-term yields on a bigger portion of the debt that has been issued at very low rates. Unfortunately, they didn't. A lot of it's in the short term, which means they readjust pretty quickly to higher rates. Conversely, they'll also adjust to lower rates if we go down to the low areas that people are expecting. They expect a lower interest rate halfway through 2024 as economic growth continues to slow down. So we'll see if that comes out. I don't think it's going to come. I don't think it's going to be that way. I think we're going to, if we do see an interest rate decline in 24, it will be later 24 as the economy does suffer from higher rates for longer.
All right. Well, I think that's a good place to wrap it up for today. And not really it's not that there's not an answer there, but it kind of falls back into our, general, like, here's what we see. Here are the risks. Here's how we are, thinking about it and talking about it. And those factors are being, kind of incorporated, right? Once the news comes out, a lot of that has been built in already, right? Like, this is kind of the way, if you're always trading on the news, then you're always on the back foot anyway, right?
Correct.
So there's a little education there on both of those topics. I appreciate it. So any last comments about Thanksgiving from you, Brad? The
Nope.
upcoming holidays.
I hope everybody has a wonderful holiday week. Hope they can sit around and they're finding themselves around family and friends. And I hope they can, I hope they can look at the gratitude that I hope their heart's full of gratitude is what I'm saying. Is I hope they also have a very, very good Thanksgiving.
Yeah, me too. And I know, everyone has different experiences of life and family and travel and all of those things. So whatever that looks like for you, yeah, I hope the same, that there, whatever piece of gratitude you have, we can really, double down on that, especially this week and through the holiday season, and just be in that space of gratitude in whatever way that works for you. So thank you so much for listening. If you have any questions that you want to hear us talk about on the podcast, you can always reach us. You can email me at Hannah, HANNAH, at expansiveceo.com. You can also get me on my website. You can go to X Squared's website as well, x2wealthplanning.com. And Brad, how can people get a hold of you?
You can get a hold of me at B Haines, BHAINES, at juncturewealth.com. Welcome any and all inquiries. And that's it.
All right, everyone. Have a happy Thanksgiving, and we will see you in 2 weeks. Bye for now.
Bye.
That's it for this episode. Thanks for listening, and be sure to like and subscribe. And again, if anything resonated with you from this episode, I would love to hear from you. Email me at Hannah, HANNAH, at expansiveceo.com, and tell me about it. And if you're ready for your greatest expansion, you can find ways to work with me at expansiveceo.com and at x2wealthplanning.com. That's X, the numeral 2, wealthplanning.com. So until next time, remember that there is enough, you are enough, and your birthright in this lifetime is to be expansive.